There we go.
All right. I don't know how we just went live, but we did apparently. I did not push any buttons, but welcome to our YouTube friends that are just joining us now. We did a spectacular introduction just moments ago and realized the live stream had not actually gone live. I guess it was just a stream of consciousness. So anyway, we'll redo that briefly. Welcome to those of you guys joining us live on YouTube. We're coming into the second hour of our weekly group coaching. We'd love for those of you that are students here at TradeSmart University to join us each week on Thursday for the first hour, where we talk about your trades, your analysis. We do a review of any content that needs examples or things that need clarified. And then we go into the second hour here, 1 p.m. Eastern Standard Time, live on YouTube. And we talk about whatever you guys want to talk about. We'll do some market commentary. We're happy to answer questions both in the Zoom room for those that are our TSU students, or if you're in YouTube, go ahead and type your questions in. We'll keep an eye out for them there. We're joined this week with the one, the only Stocklanders. We're going to get him a t-shirt with a name badge, Stocklanders. It's like Buzz Armstrong. Like, what a great name. If you're going to be an astronaut, you need a name like Buzz. And if you're going to be an amazing trading coach to hedge funds, you need a name like Stock. So we renamed Scott to Stock. And also my friend, my partner in crime here at TradeSmart University, Chris Burgess, is on the call with us today. We started talking about some interesting movements in the market, looking at rate of change and looking at some pullback levels that we could, I don't know if I should say expect in the market, but they're important numbers that if they hold, could be an encouragement to those that want the market to go up. And if they fail, could be a warning sign for those that want the market to go up. For those of you that are traders, you just want the market to move and you're fixing to take the elevator down and put a bunch of cash in your jeans. And I hope that you do. So anyway, with that said, Scott, Chris, I'll give you guys all a chance to say hello here if you want to or not.
Hello, YouTube.
We didn't coordinate very well today, but we need to have like a Discord channel for the weekly show wardrobe. All right, I want to show you guys something on the market. I was talking about this with our private group coaching students here, and I think it's an important enough topic that we should bring it up and expand it to the whole rest of the world. So those of you guys that are here in Zoom, we'll probably do a better job teaching it the second time anyway. In your charting platform of choice, I want you to go and look up an indicator. It's called rate of change. And this is giving you literally a moving average on essentially the volatility of the underlying security. In this case, we got the S&P pulled up here. I want to take a look at the Nasdaq in a second. And it's saying, this is how much it changed day over day, period over period, over X number of periods. And so mine defaults to 9 in TradingView. I actually want to look at this on a 30-day. So 6 weeks of trading, 5 days a week times 6 weeks, 6 weeks of trading. And specifically, I started looking at this on the Nasdaq, which is how I ended up at that 30. If you look back 30 days, that really began the sell-off right about here. We crashed. And look at where we're at right now. As we speak, current events, we're down an average rate of change over 30 days, negative 21.3%. And so I thought, man, what does this mean? And we've all got like the COVID crash in our mind, right? Where we can look back at that. COVID, things went bonkers. We got down about negative 20. And then we saw this V bottom and it took off in one of the most aggressive bull markets that we've ever seen. And it kind of broke all of our brains there for a minute because we're like, well, the whole world is in a pandemic. It's shut down. But what we didn't necessarily, or what we assumed, what's the word? We didn't calculate for is the ingenuity of man to say, you know what? We're going virtual. There's Zoom. We can do business through Zoom. We can use DoorDash. We can find all these ways to be together but separate. And so what happened was there was this huge boon in industry. There wasn't a slowdown of goods and things to sell. And once people figured out, wow, we can do life and transact virtually or distance or whatever, then all these companies just exploded up out of here. So I understand why isn't that drawing? Rate of change got down, boom, V bottom. I don't think this is that. Be careful the correlations that you're drawing here. It's a totally different scenario and economy that's going on. Here, we had an issue of demand. COVID crashed, everything shut down, business literally stopped. People started saving their money because they thought it was the end of the world. And then they're like, oh, it's not the end of the world. Thank you, Zoom. By the way, wouldn't you have loved to have been the owner of Zoom? Talk about just perfect timing in the world's history. Like how GoToWebinar missed that boat, but wow. That needs to be a movie someday, along with a Kentucky Derby horse race winner. I'm getting sidetracked. Today, you've got issues with supply. This is what's driving inflation right now. I don't care what the president gets on and says. I don't even care who the president is that gets on and says. It's not COVID or what, all the excuses that were thrown out there. It's supply chain. We can't get the stuff to sell. I was just trying to buy some lighting for the studio here, and it's on back order for like 2 months. A light. When's the last time you went to Amazon and tried to place an order? It's like, we're sorry, this is back ordered for 2 months. Some people are like, well, that happened last week, but prior to that, even during COVID, Amazon was everybody's umbilical cord, right? To commerce. Like you buy it, they send it because there was all this stock. But now that it's gone and now that we can't get stuff, we have huge issues with supply. And that's what's causing inflation to go up. And again, this is not that. So what could this be like? And this is where I started doing a study a little bit earlier today. We fleshed this out a little bit more in group coaching, and you guys are going to be the beneficiaries of that here on the YouTube channel. And I'm not going to talk forever, Scott and Chris, I promise. You guys are going to take over here in just a second, but we've already acknowledged COVID crash. Okay, let's go back. I'm zoomed out as far as I can on my charting application. I can't, unfortunately, switch to a weekly chart because it'll mess up rate of change. I guess we could do 6 weeks, but let's keep the study as is here. Now you've got the 2007, 2008 crash. Again, this is not necessarily that, but I've changed my tune a little bit. I'm telling y'all, current events, all I see is Head and Shoulders. And in 2007, this is all I could see back then too. It's like, this is a Head and Shoulders pattern. We came back, we tested the neckline. This is about where I started to be aware of what's going on. Right here, I had a failed business attempt. I was trying not to go bankrupt. And here's when I got the idea. I'm going to create an additional stream of cash flow, trading the stock market. Probably was had my head over my heels a little bit. And I just started buying puts. And I made stupid amounts of cash in 2008 as the whole market was crashing. Probably luck more than skill, but luck is when preparation meets opportunity. I had learned to trade. I had learned how to trade options. The opportunity was there and we took advantage of it. Again, though, this was an issue on the demand side. We had too much supply of houses back in 2007. It's the supply flooded the market. There wasn't enough demand for it, and everything crashed. And people were trying to sell their house, but they owe 20% more than the current market value of it is. And you guys remember that whole scenario. So again, this is not the same economy that we're looking at currently, but I just wonder, if you've got supply and demand that have to balance out. Imagine this is a scale. In this case, we had too much supply and not enough demand. Okay, maybe current events is you've got not enough supply and too much demand, right? People are trying to get the stuff and they can't do it. The supply is just not there. Maybe it is kind of the same story. It's just the pendulum's on the other side of the fulcrum here. And so we're looking at this. We've got these rate of changes. This is the market really selling off. A lot of you guys remember that. And so what happened when we first came down and hit 20% the first time? This is right there, right where my cursor is. Kind of like current events. You guys remember it came down over here and hit 20. What happened? Well, the market V bottomed and immediately went back up, right? I know this seems like a short period of time on the chart, but you went from October all the way through to March. October, November, December, January, February, March, 5 months, almost a half a year. Just let that sink in for a second. Took a half a year until it finally based and headed back up. if y'all are hoping that the market is going to V bottom and start heading back up, just keep in mind 6 months. That was 2008. Let's go back and do our case studies some more. We'll keep coming on back here. And I'm not saying rate of change is the end all beat all, but check it out. First, so this is a little different scenario that I think we probably need to dismiss as well. We'll get back to some other ones, and we'll take a look at the S&P as well. This is the bubble crash, the dot-com bubble collapse. And this is more like the tulip crisis, once in a lifetime thing. I don't think that the Nasdaq is a good representation of what an average rate of change would be. But again, the first time, after a season of time where we were not at 20% or more, but the first time we hit it, that was actually the beginning of this 2-3 year sell-off. I don't think current events is that, but let's go back and look at some more normal times. Here's another one. Okay. A little faster turnaround, about 3 months on that one. My point in saying all this, and you can do the study, put the rate of change on, look at the NASDAQ, look at the S&P. Here's another one. This goes back to the 90s. Okay. Another 3 months. Just because we are excessively quickly selling off does not mean this has to be a V bottom. And I stress that because we teach the Bollinger Bands all the time. In fact, let's put the Bollingers on here. Right there. And we say, if we get outside the Bollinger Band, it's excessive. It's got to bounce back up. It does. But rate of change, first of all, it's not Bollinger Bands. You can see how much the Bollingers are separating here. And I'm just trying to communicate that because the market is selling off quickly does not mean we necessarily have to bottom immediately. The S&P is another interesting study on this as well. It won't be negative 20. Use this one. Shoot, I lost my rate of change indicator. Sorry. So for those that came late, you put a rate of change indicator on there. Mine defaults to 9. I don't know if that's kind of an industry standard. Yours may default to something different. I'm going to look at a 30 period. And I'm going to put a 15 on the S&P. So when we were down 15% or more, what happened? Again, COVID. We already talked about that. Okay, this was a pretty rapid turnaround here in December of 2018. Coming on back. This is another good one. Here's how we hit 20%. Again, August, September, October, 3 months. Those are bookends. 3 months it took for this to play out until we finally gained some support. So I would, if you knew this in foresight, you would just say, okay, it's going to be volatile in through there. Here's another one. The first time we hit the negative 20, October of 2008. Of course, that was the 2008 crash. We talked about that. You can see my point. Here it is here. The first time we hit the negative 20 in 2002, this went basically sideways for a year. It was a whole year until it finally picked up and got back into a bullish trend. So do your study on that. My takeaway from this and what we were looking at in the TradeSmart group coaching call is that I'm really not convinced that this is going to be a V bottom reminiscent of the COVID V bottom. I think it's going to be volatile. Stocklanders. Scott's been talking about it's the year of the trader, not the investor. I just had lunch with a personal friend of mine, Stacey Andres, came through TradeSmart, became a fund manager, is doing amazing work. And he told me the same thing. He's transitioning his investors. And he's working with people that have millions of dollars. They're treating the market like technical traders. They're trading the market. They're not investing in the market right now. Now they're not doing it with their whole portfolio. Like that's not how people with $100 million function. But I'm just saying, savvy money, savvy investors are trading this market, not investing in it. So I've got more to share on this, but I'm going to pause, Scott or Chris, and let you guys offer your commentary here as well. I can stop sharing my screen if you got something to share, Scott.
Yeah, guys. Hey, I will show my screen. Just something I want to throw and for everybody to take a quick look at. This is the SPY monthly. Some of you probably seen this before, but this is based off of, this chart's based off the pandemic run down here. I'm sorry, the 0709 collapse, forgive me, not the pandemic, but 0709 drop here. And you can see how it's done a really good job of capturing lows and highs. This is not a curve fit. This was done just using pivots. But if that is the case, in other words, we can see it's reacted to it nicely. Where do you think this puts an area of congestion? In other words, you spent from basically 2009 up to about 2020 COVID area. You can see that now we've kind of overshot. This would be an area to give you a context currently in the next couple, the next month or so, that's around the 374. Again, as time goes forward, if we move back up higher, that line is ascending, not descending. So that number is going to climb a little bit, but we are moving sharply down. The sustainability, the slope we're going in is also not sustainable. If it were to go just stupid crash crazy, and I mean, let's just pretend it did somehow manage to get to the low of here, like just something goes completely wrong in the world. The institutions come in and start picking up down here. So you've got levels to play with, and on any rebounds coming back up, you start to look at somewhere back in this little fib channel inside of here, somewhere back up in there if we start to rebound back up inside of that. Just something to give you some context where we are, because this is a very well-defined channel. You can see the reactions at the lows and the most recent highs with this. So all we're doing is just going to that next section up. Now we're pulling back in. Eventually the market will find support. It'll go back up for a little while. And then as Josh is saying, we'll see what happens next from there. On a wave count, you're only on wave 2 of this decline on the monthly chart. Okay. If you like fibs, a lot of people like fibs. You look at where the midpoint of that's going to be roughly from this most recent pandemic low to the high, because you clearly have that situation. It's just one more way to filter your data. So Chris, your thoughts on what you're looking at lately?
Yeah, Josh was mentioning earlier how he's not a perma bear, and I'm certainly not by any means either. It's just right now, I don't see any reason to be bullish. And looking at the chart that you're looking at too, we're not to that line yet, right? So I don't see a reason for things to pick up right now. That being said, I mean, it is a great time to be a trader, right? To play either side of whatever's going to happen. But I certainly wouldn't be trying to buy the dip right now. I think you're trying to catch a falling knife in that scenario. So be careful. If you're long only, be very, very careful about when and what you're buying. And if you're not long only, if you're able to play both sides of it, then I think this is a great market to be in.
What's extraordinary about that chart on the screen right now is, and man, it doesn't necessarily feel like this to me, but that's an extraordinary move over 1, 2, 3, 4, 5 months.
Yep.
That's gotta, I mean, that's one of the largest 5 months moves on your chart. You go back to 2007, 2008, when everybody thought the world was ending, and even COVID for that matter, don't seem as aggressive as that current monthly move.
If you look at the past, this is 1, 2, 3, 4, 5 weeks, and this is where, we're on Thursday right now. So this will be the 6th week this decline. If you just look back at your history, when's the last time any of us have seen something like that? The closest thing was a run up back over in here in October for 5 straight weeks. And markets like symmetry. I mean, this is what fibs are. I mean, you see that symmetry when you were doing earlier in the group coaching. So we're getting into that zone. Of course, we look left and all that, but you've not had this magnitude of a move. Well, what should get everybody's attention is, if this is an outsized move, after extreme volatility comes what, guys? There are bands, it's just extreme, it's pulled so far apart, and then it goes back to what? Mean reversion. Well, where's the mean of this going to wind up being? And I'm just going to do this really quick for the sake of time for everybody, but let's just assume that's the midpoint between the channel without getting it perfect. You're going to have a reversion this. The only difference is, are we going to check mark back up to it or not? Right? That's the bigger question. We are going to go back to that mean at some point. The only question is, do we work to the right and then hit it and bump our head and go back down again? Or are we going to go the other side of the channel? And we're not there. no matter how we look at it, we are overextended. You're seeing lots of things that way, but you also have some pretty major big players, it looks like, getting hurt in the markets, margin calls coming in, pressure in, the Bitcoin, the cryptos and things like that. You're seeing some Nasdaq stocks get just completely slaughtered. One more thing I want to draw everybody's attention, if y'all don't mind, just for a second, that just hit me, and it's because of something in group coaching. This is ARK, and I get everybody knows this stock probably, but what I want to draw out for your attention, sorry, hang on, mistyped that, hang on. And this is typical of a lot of things. Where are we back to, guys? That's the COVID collapse. That's COVID. You have a lot of symbols, a lot of names that are back into the COVID area. So if you really start to think about this, is this not basically the trend or the base before this took off? We get that, but you can see we're right back into it again, almost as if we should have never been here. And you'll see this. One more thing on this, if I can demonstrate this. If you think about a little longer term analysis, and I actually have taught this over the years, and in fact, I talked about it in Tractions the other day, just temporarily. Do you guys look at this as basically being your mean before we had the COVID collapse? You can see we were shot. Guys, we're going to revert back to some version of this line because that's naturally the mean. Again, I'm not being penny perfect with this. We could spend time and do that, but you guys can kind of play with this. Number one, mathematically, everything reverts. Mathematically, we're going to revert to this at some point. The only question is it from a higher level or something like this? It does give you a place to look at. ARK is down there. Well, this is COVID right here. So for everybody who's looking for relative strength or relative weakness as a concept, what stocks are back at the highs of COVID? I'm talking that swing part right there that I've marked. Which ones are in it? Which ones are below it? Which ones are well above it? Well, if I go to Apple, just to give you guys a way of thinking about relative strength and relative weakness, this is way back down here. Here's Apple. Let me compare one thing to this for you, just to give you an example, and you can place on your own. Here's Microsoft. Well, this is the COVID collapse right here. This is a way to find relative strength. I'm not dismissing Head and Shoulders, anything. I'm just trying to give you guys a way to look at the markets. Because if you go look at Kathy Wood's ARK group, and a lot of stocks look just like this, unfortunately, PSFE was a $19 stock. It's now sitting at $2. And it looks horrible in every regard, right? Compare this to Robinhood. To me, Robinhood is the best tell signal for retail traders if you want to know. Now compare it to Goldman Sachs. You're looking at, I won't say best in breed, because I don't say, oh, that means I can go buy it. I'm not saying that. But when we're done dropping and you're trying to think about where the institutions might go into, they're either looking for something completely blown out like ARK, or they're looking for best in class, which means they're not back down to the COVID levels. It's just another way of thinking about things, because this whole last rip in the market, guys, has come out of the COVID lows, right? Your FANG stocks. So that's just something I hope that helps everybody get a little more grasp on just a way of thinking about looking at the markets, if that's helpful.
It's interesting you bring that up. Go ahead, Chris.
I was just going to say that it goes back to something that I've taught before in the past, doing, spread trading, pairs trading on stocks, right? Like, doesn't matter if the market's going up or going down. If you're buying long and you're selling short at the same time, you always want to be buying strong stocks and selling weak stocks, because when the market goes up, strong stocks are going to go up more. And when the market goes down, strong stocks are going to go down less, right? And he just gave you a couple examples there of some stocks and some funds that are demonstrating that exact behavior, right? Relative performance. So you can have a portfolio that's perfectly balanced, right? It's delta neutral, right? It's not heavily weighted bullish or bearish. It can be perfectly neutral, and you can still make money even if the market is directional, because you lose less on your longs when the market goes down than you make on your shorts. When the market goes up, you make more on your longs than you lose on your shorts. So it's a great way to balance a portfolio, especially if you're not the kind of person that can stare at a screen all day to trade. If you've got a normal job during the day, during the week that you go to, I think it's a very healthy way to structure a portfolio. And it'll save you from freaking out during things like this.
Guys, he's bringing up a great point, and Josh, I'll let you comment a second, but on tailing this. But my son, I think I've mentioned, some of you guys have heard this. He's in college. They have a fund. They're running. There's 30 of them. And he said, Dad, he said, we're beating the market, but we're not positive on the year. I'm like, Mason, they'll give you hundreds of millions or billions of dollars to manage if you can just outperform the market. That doesn't mean you are green, as in beating the market from a standpoint, you're positive on the year. You're just not losing as much. So that's a big deal. Their funds beat the market like every month for the past, I don't know how many months in a row. It may be 1 or 2 points, and that's it. But they're still outperforming the S&P as their index. So there are people out there who run funds, guys, that could care. They just, it's like Chris just explained to you. They're not trying to sit here necessarily, have a positive year from a standpoint of we're green, like an index green, like we're up on the year. We're just not losing as much. So your assets are not appreciating as much. If inflation is running 8% and your portfolio is down 20, would you be glad to be down 8? And that's a bad example. But my point is, you're down less than the market. That's a big deal. I've got a client right now. Their portfolio is down. One of them's down 1%, 1.5%, I think. The other one's only down 6% year to date. Do you think they're happy when they've got people they know in their life who are down 40 and 60% legit in the past 4 and 5 months in their portfolio? It's horrible to watch. Anyway, that's more of an investment macro type thought process. I'm sorry, Josh. I feel like I cut you off on that. Sorry.
You did. I metaphorically flipped you off with road rage.
That's bad. That's the worst kind of rage too.
I know. There's no excuse. Although if I'm honest, that's the only kind of rage I struggle with. Like,
really?
Why can't everybody be a smart driver? I feel like we should take driver's licenses away from terrible drivers. But then I realize I'd probably get my driver's license taken away. So this is an interesting stat that I ran across in some of the services I subscribe to and research, and I thought it's interesting to bring up here as well. Scott brings up a great point. Like, COVID kind of, it rewrote the playbook for everything, for business, how the market works. And so this is information that came out recently, the S&P 500 stocks relative to pre-COVID highs. And what I wanted to point out here is 40.6% of them are now below their pre-COVID high. 59% are still above their pre-COVID high. And then this breaks it down a little bit more. This is 0 to 5% above pre-COVID high is 8.1%, and 5 to 10% above the pre-COVID high is 7.1%. And the rest are, I would guess, beyond 10%. So that's interesting that you bring that up. And it's kind of a good segue into the other thing that I wanted to bring up with you guys. We did some work debating, what time is it? We still have a little bit of time.
Yeah.
Should we build that whole thing in again? Those of you guys that were here, you want to see how we did that? We did a lot of extensive work on measuring where the S&P could go. You're just finding a framework, giving us it's not necessarily a buy-sell signal, but a framework for how to be looking at and thinking about the price action. So I'll just jump into it here. I'm going to warn you guys that are on YouTube, especially if you're not a student of ours at TradeSmart, I'm going to talk about Fibonacci analysis, which is an advanced form of analysis. It's amazing. It's my preferred form of analysis. I would just do fibs all day long if I didn't confuse people that didn't understand how to do it. So you're going to see a lot of lines on the chart, and it's gonna start off like if you imagine a camera lens. You got a big camera like one I'm looking at right here, and the focus ring is maybe a little bit off. It'll look blurry, and you're like, I'm not exactly sure what I'm seeing. And then at the last minute, we're gonna focus it, and it's all gonna come together, and you're gonna be like, wow, this is so obvious now. So we'll do this work for you. I won't necessarily explain every step like I did in our group coaching call we had with our regular TSU students. So we're gonna start drawing fibs. And what I told them in class is, I'm cheating when I draw fibs. I'm looking right here. I'm unashamedly just seeing if where we're at currently has any logical relationship to Fibonacci numbers. And some of it's cheating because I knew going into it that we were close to some of these zones. So I put that green line right there. Can you see how that works? Then the next thing is I look over here and say, well, does that make any sense with what's going on? Now, I'll tell you, Scott mentioned this in the group coaching, and it's good to bring up now. The initial point I draw from is at the peak. So that means we start drawing from up here, but the places that we measure back to are at the, you can imagine this was like that, are at the retracements of this primary wave, motive wave, you could call it, or public participation, or whatever nomenclature you want to use there. So I'm looking back here about where these support zones are, and boom, I see that gap right there. I see another gap right there. I see some support zones all in through here. I say that makes a lot of sense. Would I, oops, I'll have to redraw that. Would I just, looking at whatever that is, 900 candles that are there, have gone, said, boom, that's the candlestick to draw to? No, I'm using experience and I'm using the data that I have on my chart to make wise decisions here. So let me redraw that on there for you. Back to here. And that puts us right at the low of the session. And actually, we're kind of coming back up to it here. Let me tighten this up. I'm using the candlestick bodies. Scott says this. I'm also stealing it. I like when he says smart things that I can steal. We want to go dig in where the bodies are buried, meaning use the real candlestick bodies. So we're going to do that 2 more times. And I'm going to look for the middle line to end up there. Boom, there we go. It's a good place to drop it right there. And then I'm going to look for the bottom line. And then we're going to tidy all these up here in just a second. And right about there. I'll zoom in, make sure this one actually got pretty good. I'm looking at this candlestick right there that my arrow's pointing at. And this one I'm looking at probably this gap right there. Gaps are your ciphers, my friends. I mentioned that an hour ago. Wherever there's a gap in the market, take note. That was something significant that happened there, and you should be using that as a measurement guide. And I'm going to tighten all of these up here, get them out of the way so I can do them one at a time. That one's good. Accuracy is important in fibs. I'm not saying get analysis paralysis, but I'm saying just do a good job. And this one here is not quite right. I'm not measuring the correct one down here. I think it was this candlestick we used. This would be important if you want to do timing. So fibs not only tell you price retracements, but they can tell you time targets as well. And so, price, we can fudge a little bit. Chris says a lot. It's more like a zone than a line. And I agree with that. Time, like it needs to be more specific. So, that candlestick versus this gap, jury's out. It might be actually this gap here. Actually, that might be the case. Could be that gap. That one's perfect. Close enough. Now, I don't even know if you can see it. There are 3 green lines that stacked up right there. That's called confluence in the world of fibs. And that's a very significant mark. It's like the market is metaphorically yelling, hey, pay attention. Like, this is a big deal right there. I'm not saying we have to stop there. I'm saying that is, for those of you that are in Foundations of Trading level 1, we just talked about pivot points. This is like the mega pivot point. And remember, what do we say about pivot points? They come with a decision, not a direction. Pivot points come with a decision, not a direction. So I'm not advocating one bit right now that we're going to come up here and bounce. What I am saying is if we don't bounce, we're looking at pulling back to, what color is that? Oh, it's right. It's already red. I need to change my confluence zone to orange. That's my color scheme. Confluence is always orange. Places where things should stop happening are typically red. Places where they should start happening are typically green. You come up with your own patterns if you want. Okay. So what I am saying is if that confluence zone is broken, these are your next very reasonable targets. And I'm curious, Scott, where this lines up with your monthly chart that you're looking at. Now I'm on SPX and you're on SPYs, so we may have to recalibrate a little bit there.
Yeah.
But we can do that. I'll just find these retracement zones and we'll look. Now I can delete all of these. No, deleted the wrong thing. Are you kidding me? Why do these things happen to me? Jim Rohn, he's a famous personal developer. He's got a lot of great stuff to say. When somebody asked him once, Mr. Rohn, why does this happen to me? He said, I don't know, but you're the kind of person that thing happens to a lot. It's such a great answer. Isn't that, you're all laughing because you know it's true. Like, yeah, there's just some people that these things happen to frequently.
You know, something you mentioned on that really quick, Josh, you're doing that. There's a study out there that talks about how, and I think Tony Robbins has talked about this with several people and it's been researched. It's like, I don't remember the number, is 70% or 90% of everything you do every day is basically a redundancy of what you did yesterday. Like 90% of your thoughts are the exact same thoughts, which means only 10% of what you do in a given day is a new thought or a new process that's not just habitual. And then people wonder why they get stuck in the rut that they're in and they don't get their breakthroughs often. So something to put in the back.
That's good. That's really good.
The research is off the charts with this, by the way, guys. Like if you really wonder.
It's interesting, the current price action here. I don't know if this is going to hold, but we'll see. I'm going to draw. I'm torn. Well, I'll put this box in here because I think this is the most sober of them all. Typically, I would draw this as a green box, but I think that could be a little misleading. So I'm going to keep it as a blue box. Basically, what this framework is telling you right now, and I mean, I know y'all that are experienced, those of you that have studied with TradeSmart University, you're seeing this. Like, it's just yelling. I wish I was a better artist because I would draw like maybe it's a megaphone. That's a trumpet, right? It's yelling head and shoulders pattern. I mean, how do you open up the market and not see head and shoulders pattern? And again, you know, Scott zoomed out monthly. We're looking at this daily. To Chris's point, it's a falling knife right here. What this framework, and I'm big on frameworks because we have to put ourselves in a model that we can make intelligent decisions. And so what this model is telling us is, as long as we trade to or within but not below this box, right, we could theoretically be bullish. But that means that we can come all the way down to this box and move on up. That's not an unlikely scenario, right? If confluence breaks, we come down and we bounce here, okay, great. Then that means this larger trend just went through a big retracement and we're going to the moon. It also means if we break through this box, there's your next targets. So this is Uber pivot point number one that you need to keep an eye on if that is broken. And I wouldn't say like, you know, we get wicked down there or even one close just a little bit below it. I mean, that's a margin of error in, you know, 10 minutes of Fibonacci work here. We could really drill that down more, but, you know, give yourself a little margin of error. But if that's broken, look to the bottom of this blue box. If that blue box is violated, look to each of these lines, and I'll put them on the screen here. There's your price points on the blue box. Yeah, I guess this is the top 38.84, 38.79. No, that's the top of the box, 38.79. And then the bottom is 33.45. Take a screenshot. Got it. Here's your line, 33.40, 30.16, 24.94. I'm curious how close this is to the work we did in group coaching because I just rebuilt this. Yeah, look at that. Almost identical. This one down here, I picked a little different candle, but everything else up above is perfect. So I would say if we did it twice in a row, that means it's probably pretty accurate. Now I'm curious how this lines up with yours, Scott, and let me just calibrate here. So we're looking at, I'm going to type these in the chat pane so I can remember them. We're looking at the candlestick on 3 November 20. This is the Zoom chat pane. 29 June 20. I'm converting this to SPY so that we can see what Scott says. And then this is 30 April 20. Okay, so if I flip over to SPY, make sure I've got the same exact. So the price points here, 3 November 20. Was right here. Not orange, that's confluence. And then the next one was 29 June 20. Right there. Is that right? Yes. And then 30 April 20. All right. So, and I'll put both of these on at the same time. Thusly. All right, Scott, 333 to 284. What did you have on your chart?
Yeah, that's gonna be, yeah. Yeah. You're good. You're good. You're good.
Interesting. And then what Confluence is current events, which is maybe being violated today as we speak. I mean, that's a pretty gnarly candlestick today.
Yeah.
Scott's probably got his phone blowing up right now.
Already has. Like, it's why if you ever watch me in the video and you're like, what's he doing? It's because this thing is literally blown up. And I've had several calls in the middle of this to boot. I'm just like, you're gonna have to wait. Is this which one? Go back to your ES chart for a second. I just want to bring up one point I don't want to not make this point.
I got to decode Scott. ES is super nerd speak for the SPY or for S&P 500.
For the minis. Yeah. Or So compress the chart for a second. There we go. So Josh made the point to everybody. Let's assume that we get to a certain level, we bounce out. Let's just assume we collapse. Where, when we go back higher, do y'all think we're going to find resistance? What's the major part of resistance? Where did we just break down from? It's 4,200, roughly. I'm rounding off. If Josh pulls a line across 4,200, you'll see your head and shoulders through there. And it's slightly above it, give or take, probably right about like that, give or take. But you can see where we just retested and broke down from. And it's roughly around that, 4,289, 4,300, somewhere right in there. I'm not, but you get the gist of what we're looking at. Guys, if we go back higher, and he could put one more line below there, maybe it is 42. Right below it.
I'll tell you exactly. So if Confluence, if this was where we bounced, this is how I'd look at it, y'all. Disregard everything below the line. But I would Scott's way smarter than me, so he can have exact pivot points, but it's that box right there, and it would be a red box.
Yep, that's it. So if it does go up, guys, you've got a place to target too if you have a longer term, if that's what you're thinking. Josh is really good at making things obvious, and it's right there in front of you guys if you'll just look and see it. So you don't think you're having to use your secret decoder ring from your box of chocolate choo-choo puffs or whatever it is. It's like, you liked that one, didn't you, Josh? So
that's good. I need a decoder ring.
I'm going to find you one. I am. I'm going to go on Amazon to find you one. I just want to be obvious to everybody. This doesn't mean complicated, guys. If you just look left with his box right now and you look historically, you can see prior support we're coming into. Right? You guys can see we're coming into that level where we've kind of hung out here before. This is large player money. This is not you and me, guys. This is smart money that builds these zones of support or resistance, and we can all see it. That was my love of technical analysis. Anybody, a room full of first graders could see support resistance here if you just keep it simple. And Fibs do a brilliant job of making that happen as the market's careening.
Yeah, Fibs are like Fibs are like, beach body. You got to put a lot of work in on the front end, but man, you can brag on the back end about how good you look. That was a great analogy. I mean, so 47% market sell off in 2000. We had a 56% market sell off in 2008. If you think that it can't go, like, y'all, it can go. So 50% market sell off would take us, oh, surprise, right to this bottom red line. I mean, I would seriously love to brag being right, but I kind of hope I'm not, because that's catastrophic. I remember my dad. I mean, he had a traditional retirement account, just peeled off a percentage of his paycheck every month, and it went into T. Rowe Price. They were managing it, and he retired at the bottom of 2008. He retired, and that's where they converted it into whatever. And I mean, he took a huge hit, bad hit, like his retirement cut in half.
Wow.
And that breaks my heart. But I think we've got to look at it sober minded. And like Chris said, I'm not a perma bear. I'm really not. But geez, like somebody take a snapshot and send this to technicalanalysis.com. That's textbook, y'all. And here's a double shoulder on it. On that happy note, let's just all believe that confluence will hold. I mean, what else? Was there something else that I was going to bring up? We got about 8 minutes left. Let me check in with our YouTube friends. Flawless analogy. Thank you. Chris wins the prize. We have so many inside jokes that are probably, let me see here. Man, I am gonna not say your name correctly. Is it Ikshmi? Prasad. I'm gonna go with Prasad because I can say that. I'm glad you're here. And Legacy Harmonics. Good to see you, Rich Lopez. Thank you very much. Y'all, we're getting some traction with the YouTube channel, our fledgling little YouTube studio channel. If you wouldn't mind hitting the like button, and if you're not a subscriber, go ahead and subscribe so you can see this content as soon as we put it out, or watch it live, participate live. Do come participate live. We'd glad to answer your questions as they come in. But we just crossed the 11,000 mark on our way to 100,000. Selfishly, I want the YouTube plaque. I want it, 100,000. And I want to make sure that we're able to help more and more people. I don't know if we've said it on the YouTube show here, but I will right now. Y'all, when good people have more money, they can do more good things. I was chatting with some people and I said, successful stock trading means more soccer games and less overtime. Or successful stock trading means building more freshwater wells and less time in the office. And I just think when good people have more money, they can do more good things. And so why not help get the word out there? Why not help people put cash in their jeans? I mentioned in the TSU group coaching call, I have 100% win-loss ratio on the April trades. Call us up, ask for the public trading account profit and loss sheet. I'll be glad to share it with you. That doesn't happen by accident, y'all. It happens with good analysis, good strategy, and good risk management. And I'd be glad to help you guys do it as well. I was trying to check and see questions. It's also a weekly 20 email range. Prasad, I don't 100% understand the question. Or is it just a comment? And if it's a comment, it's a good one. Chris, yes. Although my car is at the mechanic and I have my ride here picking me up, taking me to my next thing. So we'll have to wrap it up here in a couple minutes. All right. I don't see any questions there. Guys, I'll toss it back to the group here. You know, if you've got any parting shots, I'll have this be my parting shot. This isn't a time to be fearful. It's a time to be courageous, not stupid, not, uninformed courage. That's called casualty. But it's time to be courageous. Trade wisely. Like Chris said, I forget if we said it on the show or in the coaching, but there's opportunities to trade the market hedged both directions. If you've not watched Chris's training called Hedged, I strongly, in the strongest terms possible, recommend that you go watch Hedged. It's an inexpensive course, and he walks through specifically how you select and pair stocks so that if the market goes up wildly, you're going to be successful. If the market goes down wildly, you're going to be successful. If it goes sideways, probably not the best scenario, but ideally, you're still going to be successful. It's one of the things that I've incorporated into my trading, and it's helped me be much more successful since I've done so. So get trained up. It's the year of the trader, not the investor, and that's okay. It just means there's lots of opportunity to go around. Scott, and then Chris, I'll hand it over to you guys to take us on home. I'll stop
Yeah.
sharing my screen.
Just one quick thing, guys, before we get out of here. Like GameStop, I know there's a lot of attention on these names right now. Again, because it's making headlines. I just remind you, please be careful if you're chasing the meme stocks. Okay, this is not where they were, when they went crazy stupid up, and a lot of people are getting sucked into playing these things again. Just please be careful as we go forward. And I say that so that you're protecting yourself. The most important thing I'm saying with everything we've said today, and at least from me, I think it's more important you just understand where you're going to enter your stock, and you have a stop and you bay your stop. I'm seeing people have their accounts wiped out because they refused not to have a stop loss. You don't need to be a hero, please. If you would look at everything Josh does, there's risk management involved with it. He hounds this. So this is where I'm hearing story. I woke up to this story this morning. And so I talked about it in the coffee and cash class this morning. I just beg of you, use a stop. You can recover from that. You will not recover if you stay without a stop long term. Most people blow up, and we're seeing the data prove that again and again. Every bull market this happens. People, it'll keep going. Just that's my take this week. And I'm saying, like, people get destroyed in the markets, and they're not even my students. They're not from TSU. These are people I just know throughout the globe. I'm just telling y'all, and I don't hate to sound negative. It's more of, please heed that. That's the difference between success. Is the reason Josh has the performance in the portfolio he has, is because he's using stop loss money management, period. That's it. And targets.
An interesting riff on that, and I know this was your closing remark, but I guess I just have to get the last word in. Stacy, the guy I was having lunch with, told me during these volatile markets, he's actually switched over to the ES, which is futures, because they're able to better zero in their stops and not have to deal with market gaps, which I thought was really interesting.
Yep.
I'm not any of a futures trader. I've not done it, but it's like, that makes a lot of sense because it's a 23-hour market.
You would enjoy it, Josh. I think for anybody who trades them, I think if once you find your love with it, as long as you stay disciplined, guys, I think you'll see that. Raymond and Trader Traction Group, that's what his focus is, that and some currencies and whatever. But I think Josh would enjoy it if we ever get him to do it. That's it. Chris, I appreciate y'all, guys.
Scott got me interested in this at the top of the hour, and I know it is completely unrelated, but I did want to show the correlation between Bitcoin and the Nasdaq if we have a chance.
He's been writing formulas this whole time.
From you here.
Knew it. I knew it. Hey, Josh, is he allowed to go off topic?
Yeah, I don't know that we had an outline for this class, so I'll allow it.
Scott, can I steal the screen from you?
Scott's like a little kid with the marbles. He doesn't want to give them up.
All right, so here's the correlations between the ETF, EQs, and Bitcoin. So before 2020, there was a 2% correlation between them. They were completely uncorrelated. After 2020, it's shot up to 40%, and just recently, it's gone much higher.
Wow.
Yeah. So just in the last month.
Thank you for doing that.
Almost 80% correlated.
Dude, that's impressive to see. Thank you for doing that.
Huh.
That's
why
data.
Chris has the big bucks around here. That's impressive.
All right, that was all I had for you.
So what do we do with that information now?
Oh, Chris, you want to talk
Bitcoin as a hedge?
Don't use Bitcoin as a hedge.
Well,
yes.
But think about this, guys. If the market right now is going, if Bitcoin's going higher in the overnight, what do you think is going to happen the next day with Nasdaq? Right? You can use this to kind of gauge what's coming at you next. That's what needs to go through your mind. Like, it can be a telltale signature. If Nasdaq's still going higher and Bitcoin rolls over, just think of the correlations right here. It gives you a way to kind of at least get a little bit of window on what might potentially happen. And if they're in sync, pay attention. If they're not in sync, they're diverging. What's happening to the rest of the market? Does that help? Does everybody get that? Does that make sense, or am I losing y'all?
It makes sense. So I was responding to Raymond on YouTube. He's there, says The ES is the best. So Raymond, what it sounds like to me is that you just volunteered to give me a little private coaching session on how to trade the ES. I mean, that's what I heard.
I appreciate you, Raymond. I knew you were there somewhere you had to be. So yeah, Josh, you'll be addicted to it before it's over. Thank you for doing that analysis, Chris. That's helpful.
Yep.
Yeah, very cool.
Well, if you guys like today's show, make sure you like the video and subscribe to the YouTube channel. We do this every Thursday. So if you're subscribed, you'll get notifications when we go live next week too, in addition to all the other cool stuff that we upload to YouTube.
Amazing stuff we teach. Awesome. Blessings, everybody. Have a great rest of the week. Enjoy the weekend. We'll see you back here, same time, same place next Thursday. If you're a TSU student, come join us an hour early for your private group coaching, and then we'll go live again on YouTube at 1 p.m. Eastern Standard Time. Blessings, y'all.